Hello my dear friends, welcome back. So in this video I am going to explain what is value investing. Guys, value investing is one of the most successful and time tested investment philosophy used by investors like Warren Buffett, Charlie Munger, Seth Klarman, Joel Greenblatt. Now you might be thinking, oh, it seems like only foreigners makes money by following the principles of value investing. No, nothing like that. Value investing is universal. It is a time tested investment philosophy and it is universal. Even in India, there are so many investors who created enormous wealth by following the principles of value investing. Okay, some of the examples are Ramdev Agarwal, Parag Parikh, Ramesh Damani, Radhakishan Damani, Chandrakant Sampath, etc., etc., etc. There are so many people. So the bottom line is an investor can generate extraordinary returns in the stock market by following the principles of value investing. It's a very successful investment philosophy. That's what I can say about value investing. It's a very successful investing philosophy. And let me tell you what exactly is value investing. Value investing is buying a stock when it is trading below its intrinsic value. Value investing is nothing but buying a stock when it is trading below its intrinsic value. See, the biggest problem is the buyers and the sellers in the stock market know the price of everything but the value of nothing. That is the problem. They know the price of everything but the value of nothing. See, if you as a value investor want to create huge wealth in the stock market, then you should definitely understand the concept of valuation. That is very, very important. And in terms of valuation, you will find three kinds of stocks in the market: overvalued stocks, fairly valued stocks, and undervalued stocks. Overvalued stocks, fairly valued stocks, and undervalued stocks. If you can understand the difference between these three types of stocks in the market, then I am telling you, write it down if you want. Write it down if you want. If you can understand the difference between these three types of stocks in the market, then no one can stop you from making money in the market. No one can stop you. So first let me explain what is overvalued stock. See, if a stock is trading above its intrinsic value, then it is known as overvalued stock. Now what is this intrinsic value? The true worth of the company or the true worth of the stock. So the stocks that are trading above their intrinsic values are known as overvalued stocks. Let me give you an example. Let's say a stock's intrinsic value per share is 100 rupees, but it is trading at 150 rupees per share. See, the value is only 100 rupees, but it is trading at 150 rupees. So it is overvalued stock. Now let me tell you what happens when you invest in overvalued stocks. Now this is the most important part. So please listen to me carefully. If you invest in significantly overvalued stocks, then two things will happen over a long period of time. Either you will incur permanent loss of capital, that is, you will lose your hard-earned money, or you will generate a mediocre return, that is, you will underperform the market. Now let me tell you something. This is very important. 99% of people lose their hard-earned money in the stock market. See, I am sure that someone from your family or your friends, colleagues might have lost their money in the stock market, right? Someone from your family, friends, colleagues might have lost their money in the stock market. But do you know why they lost their money? Do you know why those 99% of people lose their hard-earned money in the stock market? It's because they all invest in these overvalued stocks. Someone from your family, friends, colleagues or relatives lost their money in the stock market because they invested in these overvalued stocks. That is the reason. So now you know the biggest secret of why most people lose their hard-earned money in the stock market. It's because they invest in overvalued stocks. So remember, never invest in overvalued stocks. The second is fairly valued stocks. Now what is a fairly valued stock? See, if a stock is trading around or equal to its intrinsic value, then it is known as a fairly valued stock. For example, if a stock's intrinsic value per share is 100 rupees and if it is trading at 100 rupees per share, then obviously it is considered to be fairly valued. So theoretically, all else equal, if you invest in a fairly valued stock, neither you will make any profit nor you will lose any money. It is similar to buying a 100 rupee note by paying 100 rupees. Our return is completely dependent on the growth of the company's intrinsic value. So it is not profitable to buy fairly valued stocks mainly for two reasons. First, the potential upside is limited. Second, there is not enough margin of safety if you go wrong on your valuation. So there is no point in buying a 100 rupee note by paying 100 rupees. It makes no sense, right? So the practitioners of value investing avoids two kinds of stocks: overvalued stocks and fairly valued stocks. So out of the three types of stocks, now we are only left with undervalued stocks. So what is an undervalued stock? If a stock is trading well below its intrinsic value, then it is known as undervalued stock. For example, if a stock's intrinsic value per share is 100 rupees and if it is trading at 75 rupees per share, then it is considered to be undervalued. Put it simply, it is like buying a 100 rupee note by paying way less than 100 rupees. This is where you can generate significantly high returns by taking very low risk. I am assuming that you understood the difference between these three kinds of stocks. But to make sure, let me ask you a simple question. Let's assume that you want to buy a 100 rupee note from me. Now tell me at what price you will buy it. You want to buy a 100 rupee note from me. Now at what price you will buy? Okay, let me give you some options. Option number 1, 150 rupees. Option number 2, 100 rupees. Option number 3, 50 rupees. Now tell me at what price you will buy it. 150, 100 or 50 rupees. If you pay me 150 rupees, then you are losing 50 rupees outright. If you pay me 100 rupees, then it's a no gain, no loss transaction. But if you can buy 100 rupee note by paying me only 50 rupees, then obviously there is a high probability of you making extraordinary profits. And that is exactly the kind of stocks value investors are interested in. So value investors are by default bargain hunters. Their objective is to buy stocks that are trading significantly below their intrinsic values. So to create enormous long-term wealth in the stock market, you should buy undervalued stocks. And I am sure that you will be having this doubt in your mind right now. But have to know the intrinsic value of a stock. Have to know whether it is undervalued, fairly valued or overvalued. Have to value a stock. I will definitely cover that in my later videos. So make sure to subscribe my YouTube channel and hit the bell icon as well. Thank you so much and I'll see you in my next video.